Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. This week we'll learn a few investment and retirement terms that everyone should know. This would have really helped me when I first started my investing journey, and I hope that it does the same for you. I'll break this video up into two parts. Number 1, common investing terms in stocks. Number 2, common types of retirement accounts that we should be aware of. Let's look at a few common investing terms in stocks. Number 1, low-cost index funds. Index funds are based on the concept of owning a large portion of the stock market in one place. To put it another way, they own the entire market, so investing in it is equivalent to investing in the entire economy. Almost every piece of investment advice that you come across will tell you to build a diverse portfolio, and in my opinion, nothing is more diverse than the entire market. They go on to say that when looking at the performance of other funds, investors, and so on over time, none of them outperform indexes like the S&P 500. They may temporarily outperform it, but they will eventually fall behind. The reason for this is that the stock market is ultimately a representation of the economy. So when one part of the economy grows, the other shrinks. The more targeted funds or investments attempt to predict booms, but they always return to the balance, which represents the economy over time. The low-cost aspect is worth mentioning. There are expenses associated with funds. These are the fees that investment managers charge to manage your fund. The reason you should pay attention to cost is that similar to how funds can earn compound interest, cost can compound as well. You may not think a 2% cost is significant, but it adds up to tens or hundreds of thousands of dollars in their pocket rather than yours over time. Another way to think about this strategy is that investing in low-cost index funds is like investing in the health of the economy when the return's going to either you or the fund's cost. You reap the benefits of the growing economy by investing in low-cost funds. Number 2, compounding and rebalancing. The books take different approaches to these issues. Compounding refers to the idea of investing in an index fund and then walking away. Its earnings are reinvested in the same fund, accelerating its growth. Of course, if things are bad enough, the money will follow. Rebalancing, on the other hand, is the process of selecting an index fund to bond ratio. Let's say that you decide on a 50-50 split. That means you'll invest half of your money in an index fund and half of it in bonds. You go over your portfolio on a regular basis, and if the amount of money in each half isn't equal, you sell and buy until it is. This is the most conservative strategy for long-term success. Dollar cost averaging. Okay, there's always the old adage of buy low, sell high. Unfortunately, from what I've seen, this is not the case. People begin to sell their bad investments when the market falls, when they should be buying them instead. Similarly, people believe that the best time to buy is when stocks are rising. Dollar cost averaging is a fancy way of saying you ignore the current price and put money into investments on a regular basis. By doing this on a regular basis, you'll be able to create a long-term average of a good deal when you buy instead of being swept up in the moment of bad judgment. This makes sense to me because I don't want to spend time watching the market for the best opportunity or saving up a large sum of money to invest all at once. Number 3, stock exchange. A stock exchange is an institution, organization, or association that hosts a market where buyers and sellers of the stocks can meet and trade during specific business hours. The New York Stock Exchange is the world's most important stock exchange, NYSE. Companies that want to list their stock on the big board, as the NYSE is known, must meet stringent requirements. If the company does not continue to meet these criteria, it will be delisted. Number 4, price to earnings or PE ratio. The price to earnings PE ratio indicates how long it will take a company to recoup its purchase price per share from current profits alone, assuming no growth. To put it another way, the PE ratio tells you how much you have to pay for $1 of a company's earnings. The PE ratio is 10 if a company reports a profit of $2 per share and the stock sells for $20 per share. $20 per share divided by $2 per share earnings equals to 10. The earnings yield can also be calculated by inverting the ratio. Number 5, PEG ratio. The price to earnings to growth or PEG ratio is a modified version of the price to earnings or PE ratio that takes growth into account. For example, the ratio shows that a company growing at 15% per year and trading at 20 times earnings is less expensive than a company growing at 10% per year and trading at an 8 times earnings. Number 6, dividend yield. The current yield of a common stock at its current dividend rate is known as the dividend yield. The dividend yield is 5% if a stock is trading at $100 per share and pays out $5 of annual dividends. With these investment terms, you'll be better able to understand lingo when you read or watch videos online. Now, for the second part of the video, let's take a look at some of the most common types of retirement accounts to be aware of. Retirement accounts. There are various types of retirement accounts that, if started early, can set you up for a comfortable retirement. Number 1, a Roth IRA. A Roth Individual Retirement Account, or Roth IRA, is a special type of account designation that can be applied to a custody account and provides significant tax benefits. It does, however, have some limitations, such as contribution amounts and the types of investments that can be held in the account. Contributions to a Roth IRA are made with after-tax dollars. In other words, you won't be able to claim it as a tax deduction. However, as long as you follow the rules, you will never pay taxes on any profits you earn from your Roth IRA investments, or when you withdraw those profits under the current system. In a Roth IRA, you can invest in stocks, bonds, real estate, certificates of deposit, and other assets. Number 2, a traditional IRA. Traditional IRAs were the first type of IRAs investors who meet certain criteria, such as total income, can contribute money to it. Furthermore, investors do not pay taxes on certain types of investment gains held in the account until they reach the age of 59.5 or are forced to do so at the age of 70.5. Number 3, a 401k. A 401k is a type of retirement plan that employers offer their employees. It usually allows investors to invest in mutual funds or stable funds with their money. Investors typically receive a tax deduction at the time the account is funded, similar to a traditional IRA. There are also much higher annual limits than with a traditional or Roth IRA. Employers frequently match employee contributions, such as a 50% match on the first 6% earned. There are no taxes due until you reach the age of 59.5, when you can begin withdrawing the funds, with required distribution starting at 70.5. The term 401k refers to a tax code section that established it. The self-directed 401k, which allows the investor to buy individual stocks and bonds in the account, has grown in popularity in recent years. Number 4, the 403b. The 403b is a similar retirement plan to the 401k. However, it is only available to nonprofit organizations. Number 5, Rollover IRA. When an employee leaves their job, they have the option of rolling over their 401k balance to a rollover IRA, which functions similarly to a traditional IRA. Number 6, Simple or Saving Incentive Match Plan for Employees IRA. The Simple IRA, Savings Incentive Match Plan for Employees, is for small business owners with fewer than 100 employees who want to provide retirement benefits to their employees but don't want to deal with the complexities of a 401k Plan K. Number 7, SEP or Simplified Employee Pension IRA. Self-employed individuals and small business owners can use the Simplified Employee Pension or SEP IRA in certain circumstances, allowing them to put aside significantly more money than they would be able to invest otherwise due to a much higher contribution limit calculated as a percentage of income. With these investment and retirement terms, you should be able to have a conversation with either a financial advisor or build a retirement plan. Thank you for watching this video through to the end. Please consider subscribing to my channel. Also, if you enjoyed this video or you found it helpful in some way, then please remember to leave a like on it. This really helps my channel grow. So please like this video and subscribe to my channel so that I can continue to make videos like this for you to enjoy.